We all think that traders are people who look at charts every day, but I open trades and never look at them for an entire month. I have my own day job and trading options is just a hobby I enjoy doing. Today I had some expiring positions and I had to log in and close them, and I thought maybe I'll share what I'm trading right now, how I manage my positions, and maybe share what is my edge when trading options. You will see a few of my real trades on different strategies like covered call, cash secured puts, and some spreads and butterflies. If you're here for the first time, this is my new channel where I share educational content and trading ideas on options. Hey, how's it going? I normally publish educational content on my channel, but for a change today, I thought I'll make a quick video on what I do as an options trader on my own account. So today is the 19th of March, which is not just any day, but expiration day. I have so many positions here that are going to get closed out. And I also have some more positions on my other brokerage account called Tastyworks. But here I don't have as many that's expiring on March. Everything here is mostly in April, except this one guy here. So I'm going to quickly go and close this. This is on ride. And this stock is trading at 13. So I have a put option for 12.50, which is mostly going to expire as 0. But to prevent any surprises, I'm going to just close this for whatever price it is right now. So the minimum I can get is 2 cents. So I'm going to put a credit and maybe get my commissions back. Okay, that's good. Now I'm left with a covered call, which is not expiring until the next month. So I don't have to look at this for a while. And I think we are done with everything here in Tastyworks. Oh, there's one more, but this is in April. So yeah, I think this looks good, and I don't think I have any other risk for today. And right now the time in New York is 3:30, which is like we have 20-30 minutes to close. So let's see if I have to take care of anything here. I'm already kind of late, but anyways, I would have preferred doing this in the morning, but I just came out for a lunch break, and I know I have to close these. So let's start with this error here. It says account deficit. Why would I have a deficit? I had like $1,000 in buying power this morning, but now it shows a deficit. So probably something happened here. So most likely I had a butterfly spread on CCX, and I think they closed out the first half of that spread. So and left the remaining half. And this now looks like a credit spread. Let's see if I can close this by buying this 12.50 back. This is the actual trade that I put on. And if you see, it's a 10, 12.50, 15 butterfly spread for 5 contracts. So this spread would have profited if the stock went up to 12. Okay, but in the last 1 month, this particular stock had mostly went sideways, so or in a decline fashion. Okay, so which means this butterfly spread that I paid like $80 to open would expire as 0, but this call option is just 1 cent in the money, which means the 10 calls that I bought would have to be exercised, and I don't have $5,000 in my account to buy 500 shares. So what Robinhood did, their trading team closed half of this, which is 5 calls from the 10 strike and 5 more from the 12.50 strike, leaving me with a credit spread of 12.50 and 15. Let's do like 500 and do a quick deposit. Okay, I put $500 in my account, and now I have a buying power of 235. So the negative deficit is fixed. So I'm just going to let it expire and go back to my other trades and see what's going on. The first one is a put spread. I sold this for 165, and today it's expiring at 0. So I get to keep the full premium that I collected. So this is an easy winner. I put it on 1st of February, so I really didn't have to do anything like look at charts every day or anything. It's just a simple, easy trade. You just put it on, and if it goes your way, the stock would finish above 5 and you can keep the full collateral. So another nice thing is when I sold this, the implied volatility was very high. So even though I collected 165 to sell the $5 put, if you go and see right now, like if you go and see 1 month out or 2 months out, you won't get as much. So right now the put for 750 itself is giving you $75. Okay, so I collected more than twice this amount. And yeah, even if I go to May, which is 2 months from now, still I'm only getting 110. Okay, so I'm gonna go all the way to September, and finally I get $2. So you can see how putting a trade with high implied volatility gives you twice or thrice the credit. So you get so much more for the risk you are taking, and that is the kind of trades that I like to put on. You don't want to trade every day, but when you do put on a trade, you make sure that the implied volatility is very high. That will give you so much more credit. So, okay, I could buy it back. I'm going to just let it expire. So the next trade here is probably a losing trade, I think. I wanted the stock to go to 35, but it only went till 33. So this spread, I only paid $8 for it. It's going to expire as 0. So I'm going to leave it as it is. And the next is a CCIV spread. So it's 20. That's a $10 put that's going to expire as 0. Right now, CCIV, I think, is at 26. 27. Okay. So this put is going to expire as 0, but I do have 2 options that are in the money. So I would probably close this for a profit, or I can roll it maybe to the next month. For now, I'm going to just close this for a winner. So let's go here and then say sell the 20 and buy the 25. The maximum width of the spread is 500, so I can't get anything more than 500. So usually I try to put 1 cent less so that it would get executed faster. While this executes, let's open a new tab and try to look at the remaining things. CCIV was a good trade, so I had did multiple trades on it from the beginning. If I show you the full history, oh, this is CCX. So if I open CCIV, this is how it basically started. So I sold a put spread, which is for 1750 and 10, and I collected around 400, 450. And then I said I'll also buy a call spread for 20 and 40, so that if the stock keeps going up, I can make another $2,000 in addition to the credit I collect. So I collected 165, and the trade was like, if it went to 40 or above, I would make another 2,000. The stock did go to 60 and came back down, and I kept rolling it. So from 40, I rolled this call to 30, and then I rolled it to 25, collecting a credit each time. So I kept rolling it and probably made like 1,000 or something on the overall trade. So let's see, this didn't close. I'm going to reduce $1 more and see if it gets closed out. I'm going to say 498. It is not allowing me to put on. I may have to refresh the page and try to do it again. Okay, buy the 195, sell the 693, 1 contract. Let's do 498. Okay, what is the next one here? So Express, I made a covered call for $4, and right now the stock is trading at $5. So it's pretty much in the money, and they might probably take my 200 shares of Express for $4 per share, which is a good thing because my cost basis is only 150 or something. So I still make a nice win here, even if the stock goes away from my account. So if you see the history, I start by selling a put for $5 and I collect a huge $230 credit. So that is the time when the implied volatility was at the highest. So this is probably 3 or 4 times the usual amount you can collect by selling a put. So if you go and see right now, Express, and try to sell a put, maybe for next month, today is 19th of the March. So if you go to next month, if you sell a 5 put, you can only collect 93, right? And I collected 250, so I collected 3 times more. So I did that, and a month later, I got assigned 100 shares. Okay, so I got assigned 200 shares because I sold 2 puts, so it was in the money, and I sold more covered calls for another 100. So if you add up all that, my cost basis was probably like just maybe 150 or 200. Okay, so I'm pretty happy if this just goes away from my account. I can always put on another trade when the implied volatility of Express jumps up. Okay, so I can let it go. Another thing I can do is I can buy this back for 123 and I can roll it. Okay, roll is simply you want to move the risk to the next week. You're going to wait one more week and maybe collect some extra money. So this is 123. Let's see how much this call trades for next week. So if we go to March 26, the same call is trading for $5 more. So this is called rolling. I'm basically moving my risk from this week to the next week, and I'm getting paid $5 to wait. Or if you don't want to do $5, I can go all the way to April, which means I don't have to look at this account for another month. And if I sell this guy, I'm getting $40 credit, which is great. Because anyway, my cost basis is just $2, and it'll even go down further to just 160. Okay, so I can possibly do something like this and stay in the trade. This has a theta decay of just $1. Okay, it's fine. I will get the money back and wait to put on the next trade because right now there's not high IV, right? So why would I risk $800 to just collect another 40 while I can make 250 with just 500 like the first time I did this? I'm going to just wait for the shares to settle and then put on a new trade later. IDEX is a covered call that I sold for $39, and I think I'm going to just keep this mostly because the share is not going to go to 350 by close of business. I'm going to mostly just let this expire. We got like 10 minutes for the markets to close. So I can maybe sell one more covered call for next month, maybe April 16th. The next covered call is trading for $42. So I can maybe put on the trade and not look at this account position for another month. So this is like what I like to do. I don't want to look at charts every day or do anything. Just put on trades and sleep better and maybe risk 200, 300 per trade. Okay, so even if this company goes to entirely to zero, I would still only lose 300, and which is just 3% of my account. So that is exactly what I like to do, and which is a great practice. It makes you sleep better, knowing that no one trade can blow up your entire account. So if you see my all-time, I had so many losses in the beginning trying to trade big, put on big positions and buying ODM calls. I lost so much, but then I said I'm going to stop. I took a break for like 2 years, and then I slowly started trading again, only pouncing on good opportunities and not trading every day. And that has really helped me recover all my losses back and maybe some more. So in the past 1 week, I think the market has been selling off a bit, so I'm definitely down. But it's okay. It'll all recover, and that should be fine. All right. So IDEX, I can sell the next 350 and collect another 42, which is very good. So let's buy this back. and put on an order for 40. I'm going to say 40 to get a quick fill, and maybe I might get 41, 42. Let's see. Okay, it got filled at the ask, so that's okay. Now my risk has been moved over to the next month. Okay, now you see IDEX, it says 416 instead of 319, and I collected another $40 as a credit. Okay, so I'm going to go back and look at the next trade and see what's going on. So the CCIV trade still has not gotten a fill, so we might have to maybe reduce it even further, I think. Okay, I'm going to buy this. Sorry, I was looking at the wrong thing. So let's try to put on a new trade and see if I can close this. This is 196 and this is 690. The credit is going down further and further. So even though this is worth 500, it's difficult to get a fill because you have to give up some of the profits to get a fill. Let's do 496. I'm giving $4 to a market maker or a high-speed trading system to just fill this order for me. They might exercise quickly and sell these shares in milliseconds. Good. I got a fill for 497, even though I quoted just 496. Okay, so now this risk is off, and this trade should go away from here if I refresh. Sounds good. So all these are gone. Express, I'm gonna just let the shares go away. Nokia, I did this trade for just 4 cents, thinking that if the stock keeps popping up, this was a trade back in February or January, maybe Jan 27, 26, when the meme explosion was going on. So I don't think Nokia is gonna go to $8 in the next 3 minutes. So this is gonna expire at 0, and I don't care. And then sauce is another meme stock, and I just put $10 on it. So I knew it's not going to go up there, but just in case if there was some crazy short squeeze that pushes it all the way, because it was definitely like shooting up crazy when I put on the trade. So I thought, okay, I'll just profit from the IV if it does go up. So this is going to also expire as 0. And then everything else here is for April next month. So I don't have to worry about any of these until next month. So I think I took care of most of the trades here, and yeah, and I think I'm good for the next 4 minutes when the markets are going to close. So definitely I was tempted to roll this and collect more credit, but I'm gonna just wait. It's okay. I can always sell another put when the IV goes up. So I'm gonna quickly show you where I do all the IV. There's a website called Market Chameleon. This is a great website. They have a lot of resources, and it is a paid website, but some of them are free. So if you look at, say, Express, you have an implied volatility chart. You can look at how the IV has been. On the left is the stock chart, how the stock has been doing in the last 1 year. And on the right, you have the implied volatility chart. So this is how the IV has been throughout the last 1 year. And like I said, you will get more credit for the risk you are taking when the IV is high. So if you see this, you can even expand this and make it even bigger. So as an options trader, what I'm looking for is just high volatility. Sell options when the IV is high, because this is when you collect 3 or 4 times more credit and give yourself a high chance of success. Okay, when I sold this Express put, let's look at the date when I actually did that. It was around February 1. Okay, so I sold this 2 puts for $230, and this was on February 1. And if you come here and look at the chart, the February 1 is when it was like exploding, and the IV went up to 400 around this time. Okay, so on the 1st of February, if you see, the IV was 380, which means you would get like 2 or 3 times more premium when you sell options at this time. So of course the risk is also high when something crashes so big, but I do look for support. Support means how far the stock can crash and recover. So mostly the stock has support near $150. So pretty much like even if you are collecting 230, right? So if you collect 230, anyway, you're going to own the stock at near the 250 levels. And if you sell more options like covered calls or whatever, like this one, I collected another $100. And again, I did not sell a covered call immediately, okay? I got the shares at some point, but I waited like a couple of weeks to start selling a call. So if you see March 8, again, there was a small increase in IV. So I get the shares. And then if you see on March 8, do you see this spike? On March 8, the IV was 250, but the day before it was just 140. So if I sold this call option, if I sold this covered call one day before, I would have probably collected like $20 or $30. That's it, okay? So again, I collected 3 times more premium just because I waited for a quick pop. So this is like the secret sauce in options trading success. The first thing is you want to be selling options. You don't want to be buying them. You can definitely see what buying has done to my account. So I have the Nokia $8 calls. Oh, here comes the bell. So I have the Nokia $8 calls. Everything has expired. I have the SOS $25 calls, and all of this has expired. So buying options, OTM, or the money options is probably a losing game, as you can see here. And everything that won today on this 19th of March are the trades where I sold options. So always try to sell, and don't sell every day. You just wait for the right moment and then you sell it. And trust me, that is when you have the most amount of success, or at least the least amount of failures. Even if you lose by collecting $230 and not just like $50 or $10, right? So sometimes you would just collect like $5 and the stock crashes. You lose so much. So why would you sell a put for just $5? Then you can just wait for a few days for the right chance and then you sell it. Okay, those are some things that work for me. So do definitely check out my channel where I make different videos on education and trading strategies. I just thought I will make this day in the life of a trader video. So if you don't know what are options or how to trade options, or if you're looking for a quick, easy examples, I'm definitely making a start from zero course on my channel, and I hope to make the rest of the videos soon. I just made like 2 of them, and I hope to publish the remaining in the next few days. And I also post trading ideas, like this is a spread I did and it works for me, and this is a trade I made for just $1 and I got out with 700% return. So I'm going to try and make these type of videos where I try different experiments with spreads and options in general and try to make a video of a specific trade. So definitely different things I have coming up, and this is an FAQ series where I try to answer common questions on options trading. So here is a video where it's like what is implied volatility, and I'm going to try and explain that with using by catching an Uber. So take simple examples and connect it with the complex thing that is options trading and try to explain it. So that's what I'm hoping to achieve with this channel. So yeah, do subscribe to it and let me know what you think. Okay, so good luck with your trading. Post any comments you have on any of your trades, and whatever I know, I'll try to answer. All right, good luck to you guys once again, and I'll catch you in the next one. Thank you.